Step into the super crowd, where dreams take flight. Learn to invest like a pro. Make your future bright. Impact investing, changing the game. Crowdfund the world, it'll never be the same. Super Crowd Hour, come join the ride. Change the world with us, we're on your side. Super Crowd Hour, come join the ride. Change the world with us, we're on your side.
Welcome. I am so excited. Today I'm just thrilled to be here with you to talk about our monthly Super Crowd Hour. Today we're going to talk about how to build a VC-style impact crowdfunding portfolio. We're talking about how you can make money investing your money for good, for impact, via regulated investment crowdfunding. This is going to be a fun discussion, an opportunity to learn a lot, and I invite you to stick around for the whole thing. If you are interested in making money, if you are interested in doing good in the world, and you're interested in doing those things together, wow, this is where you want to be today. So let me just walk you through a couple of things as we get started here. Oh, life is hard sometimes. We are really excited to be here, and thank you very much for being with us today. We're going to have a really great discussion. I want to express appreciation to inform my colleague Chandan Saha, who is the producer of the show. He's a phenomenal human being, and we're grateful for the work that he does, often behind the scenes, to make everything work smoothly here. Today, we're going to be talking about some financial things, talking about money. I want to be clear, this is an educational program. I'm not giving you personal financial advice. If you need advice, want advice, you need to talk to a financial advisor, a CPA, an attorney, someone who can help you with those details. Today, we're educating you, and I'm thrilled to have the opportunity to be here with you for that purpose. I want to invite you all to think about joining the Impact Cherub Club. Every month, the Impact Cherubs get together. We're cherub, what is that word? A little angel, right? A young little baby angel. So we're a group of angel investors who get together to talk about every month what small investments we can make via regulated investment crowdfunding. We've been doing this for years and invested tens of thousands of dollars over the years together, but we usually invest very small amounts each month. So we have a lot of fun. We make a big difference in the world. We meet on the third Tuesday of each month at 1 p.m. Eastern. If you're interested, just visit impactcherub.com to learn more. We'd love to have you. I want to invite you to join the Super Crowd. The Super Crowd is our subscription / membership or association for members of the Super Crowd. If you are interested in making money and doing good golly, you want to be part of the Super Crowd, I invite you to join. Just scan this QR code and enroll today if you haven't already. I want to also share some of the insights. Most of the insights that we're going to talk about today come from my book, How to Make Money with Impact Crowdfunding. I invite you to check it out. You can get a free download of the book just by scanning this QR code or visiting the short link 4sc.fund/ebook free. 4sc.fund/ebook free. I also recently wrote a book called Crowdfunding Made Simple, a step-by-step guide to raising capital using AI tools. So if you are by any chance an entrepreneur who may be interested in raising capital from the crowd as well as investing, check out this book. You can also get this one as a free download at 4sc.fund/CMS free. So check it out there. Now, we're going to jump into the program. I'm going to play a little homage to the sponsors that make this great work possible. We'll be right back.
Digital Niche Agency is the top investor acquisition agency. DNA has helped founders raise over 9 figures via regulated investment crowdfunding with a 3-pronged strategy using digital advertising, content marketing, and strategic outreach. You can't argue with success, but you can learn from it. Put the best to work for you. Book a call today.
Proactive Impact Fund creates social impact through real estate, and you can invest. Learn more at proactiveimpactfund.com. Start today. Brian Christie and his team bring strategic innovation to crowdfunding. Scan the QR code to learn more about Crowdfund Holdings innovators now.
We are grateful for meaningful support from the American Independent Business Alliance, Ridgecrest Herbals, Move the Needle with Rob Kaplan, and Rotary International.
We appreciate our co-hosts.
Prepare to be inspired by Devin Thorpe, a powerhouse in impact journalism and social good advocacy. This best-selling author hosts the acclaimed Superpowers for Good TV show featuring global changemakers like Bill Gates. With a readership of over 2 million, his 500-plus Forbes articles have shaped the dialogue on purpose-driven leadership and crowdfunding innovation. A sought-after speaker from the United Nations to Johnson & Johnson, Devin's unique blend of expertise as a former CFO and investment banker fuels his captivating presentations. Please welcome the dynamic and visionary Devin Thorpe, here to empower us all to harness our superpowers for good.
Okay, we're going to have such a fun discussion today. Let me just point out that throughout the discussion, if you have a question for me, I want you to feel invited, welcome, and encouraged to ask questions. And the way to ask a question is just to visit it's very simple. You're just going to scan this QR code on the screen that you see there, or just type in the URL 4sc.fund/question, 4sc.fund/question, or scan that QR code that you see on the screen. I invite you to scan that QR code now. I won't keep it on the screen the whole time that we're talking, so that if a question comes up, you can go ahead and just submit that question, and then I'll see it instantly, and I'll be able to respond to your question. Perhaps even, I may be able to pause the presentation to answer your question if it comes in and it's relevant. So feel free to submit your question there. With that, let's proceed. Let's talk a little bit about how to build a VC-style impact crowdfunding portfolio. We're going to talk today about the mechanics of investing like a VC and the risks and opportunities of investing like a venture capitalist. So you're going to learn a lot today. Again, not investment advice, educational content today. So, whoops, we covered that, didn't we? Whoops. I want to just frame the discussion a little bit. And I think this is important. Most of us have some stock market investments, and quite frankly, those investments tend to be our highest investment return opportunity. They tend to exceed the opportunity for investing in real estate. It's also easier and more accessible, especially today, using Robinhood or Charles Schwab. You can buy very small positions, $10 positions in the stock market, and with zero fees. So it makes economic sense to be investing there. And that tends to be the best we can do as ordinary, everyday investors. Now, the wealthy have more options. Now, they can invest in venture funds and hedge funds and all kinds of things. They generally have very high minimum investments, sometimes $1 million or more. And so even people who are quite affluent aren't really able to invest their money there. So oftentimes the best return available to us is what you get in the stock market, which is about 10%. So investing with a VC strategy won't always, but can yield higher returns than this. We'll talk a little bit about that. I want you to remember, though, that the stock market, although it very consistently over the very long haul yields about 10%, in the short run, it can vary dramatically. The last couple of years, very big years, about 30% per year appreciation in the stock market. Really gonzo numbers to see that happen the last couple of years. But the reality is the opposite can happen. Back-to-back 30% declines like we had in the 2007, 2009 period, when the stock market dropped almost 60% in just 18 months. So it can be really painful too. Now, when we talk about impact investing, we're talking about changes that happen in the world because of your investments. And we all want to see the world be better. We all want the things to get better. We may not all agree on what should be better or what it's most important to solve, but we all agree that there are ways it could be better, and using our money as an investment tool to make it better is a great strategy for both making money and doing good. Now, there are some examples. Some of the things that resonate with me are reducing carbon and improving public health, especially global public health, and economic empowerment. Those are kinds of things that resonate with me as impact. But you can choose your own impacts. You don't have to follow my lead. So investment crowdfunding is regulated by FINRA and the Securities and Exchange Commission. And there are about 100 companies that offer securities online under the rules or regulations of regulation crowdfunding. Some of the big names that you're most likely familiar with are names like WeFunder, Republic, and Start Engine. But there are literally many dozens of others that are active out there. Some broker dealers have pages, and the portals have their pages. So this is a growing, dynamic space. Over $2 billion has been raised this way from the crowd, and over 1 million people have participated. So at the intersection of regulated investment crowdfunding and investment impact investing, we have impact crowdfunding. And that's what we're talking about today, trying to build a VC-style portfolio in the niche of impact crowdfunding. Can it be done? I'm going to tell you how. Yeah. Okay. So there are 4 types of investments that venture capitalists consider. Now, I will tell you, they have a strong preference as a group for one particular type, but that doesn't mean they never invest. It depends on the stage of investment. The earliest stage investors are probably investing in the widest range. And so we'll talk about all of the different options. Convertible debt is one of the tools that they invest in. What is convertible debt? Convertible debt is a note that the issuer, the company that's raising capital, signs and promising to return your money or convert it to equity. And generally, when a company that has growth potential signs a convertible note, the intention is not to pay it back, although that happens occasionally. It's more likely that they plan to convert the note to equity and let you achieve appreciation over the years. And so that your investment of $100 could someday be worth $1,000. That's kind of the goal. A simple agreement for future equity is like a convertible note that has been stripped of the debt features. There's no interest rate. There's no real note. It's just a contract that entitles you to get equity in the future if a triggering event occurs. And it's the same kind of triggering event that would be used with the convertible note, typically a large capital raise, but it could be other things as well. I will note that the simple agreement for future equity, the acronym SAFE, of course, is obvious and frequently used. It is not a particularly safe investment, especially in the crowdfunding space. The safe instrument, got to just flag this here. If it doesn't convert, it isn't at all clear what your claim on the company and its assets are. And so I'm not a big fan of investing in safes. And some of the venture capitalists and savvy investors I know also avoid them. That said, it's a very founder-friendly investment. And so when you're trying to help a founder, this is actually, there are arguments, this is the best. And the reason is it doesn't take a lot of lawyering. It doesn't take a lot of legal fees to get this set up. And as a result, entrepreneurs aren't spending their precious capital at those early stages on lawyers. They're spending it on developing a product and getting to market. And so that's why it's still reasonable to consider investments, even though this is not an investor-friendly structure. Okay, preferred stock. This is what venture capitalists most often want to invest in. And there are a variety of reasons, but the primary reason is when you put in $100 on a preferred stock investment, the fundamental principle of the preferred stock, and there are lots of variations, but the fundamental principle that applies to virtually all is that if the company is sold, you're guaranteed to get your $100 back before common shareholders get anything. And customarily, the founders have common shares. So that means you get your money as an investor before the founders get their money. Now, this is actually almost a little bit punitive in its nature to the founders. So as an impact investor, sometimes this isn't the preferred choice, but this is the preferred choice of venture capitalists. So be aware that this is the tool of choice. If you see a company offering preferred stock, I would not shy away from it because it's not founder friendly. If they're happy to offer it, if I were you, I would be happy to invest in it. Now, the fourth option is common stock. This is probably the least often used by venture capitalists of all the options, but it is something we see a fair bit on crowdfunding sites. Something like 20% of the deals represent the sale of common stock. And it just gives you a share of ownership that, quite frankly, is the kind of ownership that you have when you buy stock in the stock market. You're getting common stock as a general rule, not always, but generally speaking. You buy shares of Tesla or Google or Alphabet or Meta, you're buying common stock, right? So that's it. Venture capitalists don't generally buy common stock, but you do see this offered a lot through crowdfunding, and so we need to be aware of it. Okay, let's talk about what venture capital is. There is a perception, I think, sometimes that venture capital funds are the pooled assets of the fund managers who are wealthy people. And that really is rarely the case. Not that it never happens, but that's rarely the case. The fund managers are required, the general partners are required to put in a tiny amount, but the bulk of the money almost always is from limited partners, outside investors who have no day-to-day operational role managing the fund. And as a result, these folks are just passive investors. And so the venture capital fund is often managed by people who may not be especially wealthy. Typically, they're pretty affluent, but they're not especially wealthy necessarily because they're managing other people's money, not their own money. Their goal is to generate high returns. And depending on the stage of investment, later stage venture firms are probably least like what we'll describe today, in that they expect to get something back on virtually every deal they invest in. Their goal is to see it continue to grow. But earlier stage companies are investing with the strategy, or earlier stage funds are investing with the goal of seeing a tremendous growth from a few of their portfolio companies and then losing money on many of the others. We'll talk more about this. One of the things to be aware of is that a venture capital fund typically charges very high fees. The best funds charge even more than what I've got on the sheet here, but the 2% annual fee starts to really add up. Imagine that you're in that fund for 7 years, 2% a year. That's 14% of the money goes to the management team. 20% of the carry or profits. That's a big chunk. So let's say the fund before fees doubles in value from $1 to $2. Well, of that appreciation, 14 cents probably goes to the annual 2% fees. So that brings it down to $1.86. And then 20% of the appreciation goes to the fund manager. So 20% of that 86 cents, or about 16, 17 cents, goes. And so the profit left for the investors is only about 60 cents on the dollar, instead of a doubling. So you see those fees really are pretty substantial. What does that mean? Why am I bringing that up? Here's the thing. If you are investing directly yourself, you don't have to pay those fees. You have to pay those fees. Now, I do want to encourage you to be mindful about the fees that the portals charge. Some portals charge significant fees to both the entrepreneurs raising capital and to the investors. So you want to be mindful about those fees. Some portals don't charge any fees. Okay, to the investors. All the portals charge the entrepreneurs at least something. Let's talk a little bit about the crowdfunding alternative. When you invest in crowdfunding, you're not paying a fund manager. You're buying making your investments directly yourself. And what we're seeing is that more and more, some great companies and great ideas are raising capital from the crowd. But it takes some effort to really discern the truly great from the merely sexy. And so we'll talk a little bit about that, but in a future session, we'll talk about how to do what we call due diligence. We'll talk more about that today a little bit, but we'll do it in another session. But you can find great companies through crowdfunding now. I want to encourage you to use what we might call a crawl, walk, run model. As you develop your skill, expertise, and practice around crowdfunding and investing kind of in this VC style, I want to encourage you to start small. And it's important. I don't think there is any better way to learn how to do this well than to do it. But if you're going to do it, you have to start small with amounts of money that you genuinely and easily can afford to lose. Because no matter how well educated you are, no matter how, where you got your MBA, right? You're going to want to practice before you really start to scale up your investments. So I would encourage you to start with, opportunities to invest with $100 or even less. Some of those portals and some of the offerings. I once saw one that had a minimum investment of $1. So you can look for those opportunities and begin to scrutinize and practice with real money, but in very tiny amounts so that your education isn't expensive. And then as you gain confidence and begin to prove the model, and you're seeing the companies you're investing in on average succeeding and making progress toward a successful rise in growth, then it makes sense. Yeah, pull the trigger and start doing more and more until you can move a meaningful portion of your assets into this strategy. Let's talk a little bit about how the VCs invest. So typically a fund would have at least 10 companies in it when a portfolio is built, often up to 30. It's rare that they would have more than that. I will say one of the opportunities available to crowdfund investors is because the minimums are small, we can get a little more diversification if you want it. But I would encourage you to at least plan on that 10 to 12 as a bare minimum number of investments so that you are getting some diversification in your portfolio. Venture capitalists often reinvest funds. They'll keep some of their money sort of dry powder, right? They'll keep that available cash so that as their portfolio grows, they can reinvest in those that are doing the best and maintain their ownership stake and percentage, perhaps, in the companies that are doing the best. One of the things that I got to reiterate, and let me just point out for the first time, I don't think I've mentioned this, but a venture fund, I hinted at this when I talked about the 7 years and the 2%, right? The reality is it takes a long time for small, startups to become big businesses, right? Tesla was started over 20 years ago. Now it's a giant business. Everyone, who invested early in Tesla is rich today, but that opportunity took years to mature. It didn't happen overnight. In venture capital, there is this concept called the power law, and I want to make sure that you kind of understand it. This is the concept, and I kind of alluded to this a little bit, but this is the idea that most venture capitalists are getting the bulk of their returns from one or two portfolio companies, and recognizing that many of the portfolio companies, a third to half, will literally yield zero, and the balance will do okay, but not great. They may just get the money back. So a venture capital firm that puts $5 million into a deal recognizes that, kind of one of three things happens. That $5 million becomes zero, or it becomes $5 million, or it becomes 50 or 100 or 200 million, maybe even 500 million in most exceptional cases. And that's the approach and attitude you want to have if you are investing with a VC mentality through crowdfunding. You need to look for businesses that have the potential to scale that much that they could become 50 times bigger, 20 times bigger, 100 times bigger. And recognize that sometimes you and the founders are going to be wrong, and that investment will yield zero. Or in some cases, they'll just never be able to scale up. They can survive, but never thrive. So those companies become kind of sometimes I've heard VCs refer to them as zombie companies, and eventually they'll work to figure out how to get their money back out of those in creative ways. So I want to encourage you to think about, if you're interested in this approach, and you don't necessarily need to use this approach, but those of you who find this daring world of backing startups to be exciting, you want to do it, then okay, great. I would suggest that you develop a fairly, formal investment plan, right? And so what I'm talking about is decide how much you're going to put into each deal over what span of time. So you might say, okay, I'm going to build a portfolio over 2 years, or I'm going to build a portfolio slowly over 4 years. And I'll put $100 in each deal, or I'll put $500 in each deal. But make sure that the allocation you plan for will get you to at least 10 and better 20. You could even do 30 or more if you want companies, so that you're getting good diversification. You don't want to put all of your eggs in one basket. You've heard that old saying a million times, and this is where it is most relevant. There's no place on earth where that idea of not putting your eggs all in one basket is more relevant than it is here. Let me remind you that if you have questions for us, you can submit them in the comments on the social media where you're watching this. So if you're watching on LinkedIn or Facebook or YouTube, you can just submit questions right in the viewer there, or in the comments. You put and I'll see them. You put them in, I'll see them instantly. Or if you're watching on television or otherwise, you want to submit a question, you can go ahead and submit a question. And here's the secret: if you are watching a recording of this show, feel free to submit a question using the question form at, let me just pop that back up on the screen. Visit 4sc.fund/question. Submit that question using the QR code there too, if you want. Just scan that and send me a question. I'm happy to answer the questions while we're talking today. Okay, so you've got the plan to build your portfolio in these various investments. I want to reiterate the long holding period. Venture capital funds realistically plan on about 7 years, but they almost always allow for up to 10 years for holding their investments. What I'm seeing in the true startup world, not the small business, there are a lot of small businesses. And I want to maybe just pause and draw a distinction. Right? If you're investing in a restaurant or another small business that isn't likely to scale quickly, that's not really a venture style investment. They're great investments. I invest in a lot of them all the time. Love them. I think they are great. Makes sense. But that is not a venture capital style investment. The true startups we see on crowdfunding sites they're not always, but they tend to be earlier stage companies on average. Recently, I scrutinized one that still had a product in development, was years away from generating revenue. Great company, very inspiring company, doing some really cool work. But the reality is those investments take a long time to mature to where there's going to be a liquidity event. So with crowdfunding investments in startups, VC style kinds of things, you could easily see your portfolio require up to 10 or 12 years for all the investments you make to mature and yield a final outcome. Most often, not a good one. But when they do, when they really hit, the returns can be astronomical, astronomical. So you've got to start with a mentality that says, okay, I'm willing to sit in, I'm going to park this money for a long time. I don't need this to buy groceries. I don't need this to reinvest. I don't need this for anything else. I can just sit and watch this $100 or $1,000 or $5,000. I can just watch that grow over a long period of time. And that's great. That's great. That you just got to be ready for that long haul. Let's talk a little bit about how to measure success. Along the way, there are signs of progress. And let's be really clear, right? If you're doing truly a VC style investing, you're going to see your losers lose long before the winners win. Isn't that's kind of scary, isn't it? So you need to expect that, right? It takes a lot longer to reach a successful exit than it takes to fail. You can fail pretty darn fast, right? So you may invest in some companies that will fail in under a year. Right? You go, holy cow, that didn't take long. We invested, we put in collectively $1 million, and now 11 months later, you're telling us it didn't work and you're done? Oh, heartbreaking, right? But that happens. That happens. Within 2 years, 3 years, you'll see businesses fail. Sometimes even businesses that thrive for a while will get overextended. Something will happen. Market breaks in some ways. A competitor comes in and cleans their clock. Anything can happen. So you'll see your failures first. Don't be discouraged. But as you watch your portfolio, you will see some companies that are raising capital again. Oftentimes they'll raise at a higher valuation. That's a sign of progress. That suggests that the shares you bought, maybe you bought shares for $10. Maybe they're issuing more shares now at $15 a share. That means you've had some appreciation, a 50% appreciation. And they might continue to grow, raise more capital. The good companies tend to communicate well. Not all of my portfolio companies are communicating well and effectively with me. It is a frustration and a reality. That's why one of the things I love about crowdfunding is any individual investment. It's to be pretty insignificant. The portfolio, pretty material. And I get excited about the ones that are giving me good reports, regular updates. And so we can see the progress they're making. We can see that they are in business. We can check their social media, their websites, and we see the activity continuing to percolate. So that's the kind of thing that allows you to sort of see and track your success. And along the way, you will start to see some of the money come back. Some of those convertible notes. It's rare, but some of those convertible notes will get paid off. The company will exercise the option to return your cash with interest. That's a pretty good deal. Usually those interest rates are pretty reasonable, 7 to 10%, 12%, sometimes even 15%. So that's a pretty good return on your cash if that happens. And I always celebrate that outcome. It's not what you hoped for, but that's cash you can now redeploy into something else. You get another chance, another crack at the portfolio of investments there. So you can continue to do that. Eventually, you'll start to see some of the big winners get sold. And eventually, you may even have a portfolio company that does an IPO where they sell their shares to the public. And usually, those valuations tend to be substantially higher than the valuation at which you invested. Not always, but oftentimes. So that's, be patient. You'll see that success begin to manifest itself. I really want to point out that doing venture style investing via crowdfunding does realistically give you a hope, not a guarantee, a hope of beating stock market returns. Venture capital returns for the best funds are typically doing really pretty gonzo numbers. The very best funds consistently generate double stock market returns. But it's very hard. You've got to be super rich to get your money into one of those funds. So it's not an option for us. And let's be clear, the worst performers in venture capital don't just fail to beat the stock market, they typically lose money. So they'll take in $50 million, $100 million from investors. And at the end, they return less than that portfolio from their portfolio. So that is a pretty good rule of thumb. So even among professional venture capitalists who successfully raise capital, there is a wide range of outcomes. So one of the things that will help you is that you will not be paying management fees, and you won't pay a carry. So that helps to protect your portfolio value a little bit. The offset to that is some of the aspects, some of the best opportunities for investing in startups aren't yet consistently available via regulation crowdfunding. I think that's going to change over time. I want to encourage you to learn these skills now so that as the marketplace evolves and matures and more companies, more and more startups use crowdfunding to raise capital, you'll have an opportunity to be there and invest and participate in those growth stories. So realistically, you can hope to beat the stock market by 2 or 3 percentage points. Now, if you were to do that consistently over decades, that would mean that your venture style portfolio would beat your traditional stock market portfolio in growth pretty dramatically. You know, maybe doubling in value every 5 years or so instead of every, say, 7 years in the stock market. So you can see over a span of 2 or 3 decades, it would really start to add up the benefit of having that kind of portfolio. You just have to remember there are no guarantees, and you could easily have a period of time where, for a variety of economic reasons and other, that you have a real big setback in your venture style portfolio. So for that reason, it's really important not to put all of your money in a venture style portfolio. The reality is that it is genuinely risky, and very few people, even among the professional venture capitalists, have all of their money invested in venture capital. They invest in other things, other assets, including public market investments and real estate and other assets. So I encourage you to keep your VC style investing to a fairly small portion of your portfolio. You can argue about what that percentage is, but somewhere between 2 and 10% is probably a range to be thinking about capping your VC style investing via crowdfunding, so that you are never wiped out by having your portfolio decimated, as it could be in a bad situation. It could happen. Okay. I want to make a key point here. I alluded to this at the beginning. I want to come back to this point. There are some who say impact investing requires you to accept lower returns. I am not convinced that that is true. In the public markets, there's really pretty good data that there is no penalty or only the tiniest of penalties for using an ESG or environmental, social, and corporate governance screening for investments. And there's even some data that suggests that if you apply those screens, you actually increase your returns. And impact investing is the same kind of deal, right? If you are investing, for instance, in companies that improve the world, you are reducing the risks that the world is experiencing. And there are benefits to that, not only that are not necessarily captured in the investment, but many that are captured in that investment. So as you reduce the risk in the world, you may be benefiting your own portfolio in a fairly direct way. But as I go about investing for impact, and I've made many dozens of investments, I'm seeing good returns, and virtually all of my investments have some measurable impact that I can defend, and I'm seeing good returns. You'll have your own experience, but the reality is I'm not seeing any trade-off using an impact investing approach to my crowdfunding investments. So I want to make one critical point here as we begin to wrap up, and that is that if you think you are using a venture capital investment style strategy, but you've only invested in one company, you're really just gambling, right? The odds of one investment paying off are just like betting on a roulette wheel in Vegas. It's that kind of odds, and so it's really not an investment strategy. It's just gambling. And you may want to do that with $100 for a friend, sure. But don't kid yourself into thinking you're a venture capitalist because you made one investment for a friend, right? You want to get serious about this. If you want this to be a part of your portfolio, part of your strategy, you got to build that portfolio and diversify it. Here, there's a key thing that I learned from a dear friend and advisor, Brian Belay, and that is that due diligence is absolutely essential to increasing your returns. The correlation between the time, the hours spent on each investment doing research, understanding the risks and the possible outcomes compared to returns, right? There is a tremendous positive correlation, and research has shown this, right? Scientific studies. The more time you spend researching, the better your returns, and the difference isn't small, it is dramatic. It's dramatic. So we're going to have a future session on doing due diligence. So I want to encourage you to come back every month because we always have great lessons to talk about, and we'll talk about this due diligence. I'm not going to lie to you, right? The due diligence isn't always fun, but that's the difference between investing for fun and investing for a real return. And there are some great ways to do it. I want to again invite you to download my free book, my How to Make Money with Impact Crowdfunding. You can download that book at 4sc.fund/ebook free. Quick instant download. You're going to drop in your email address and then you'll instantly get the book emailed to you. So it's instantaneous. And I'm happy to take questions now. If anyone has a question as we begin to wrap up today. Again, the You can ask questions just by scanning the QR code there, or by just, you can scan the QR code, or submit your question as a comment in the comments on YouTube, Instagram, Facebook, wherever you may be watching. And I want to encourage you to participate, to join the conversation. Some of the questions that I get most often are, which portal is the best portal? And I want to be very clear that I am portal agnostic. I've invested across at least a dozen different crowdfunding portals. All the big ones, Republic, WeFunder, Start Engine. I've invested in via all of them. And there are good investments on all of them. Do I have some favorites? Yeah, I'm not going to share that today. But the reality is the portal is not super important to the success of the company, or even the crowdfunding raise. There's no portals. I've never seen a portal that doesn't have some companies that failed to raise the capital they were targeting. And I've never seen a portal that didn't have some exciting successes where they raised a lot of money. And so there isn't a right portal and a wrong portal. The differences are subtle. I would pay attention to the fees. Some of the portals charge fees that are a little bit punitive to small investors and give some meaningful preference to the larger investors. Other portals, no, they don't do that. So I'd encourage you to be thoughtful, to look at those kinds of things, but remember, there is no right, there is no wrong portal. You can find good investments on all of the portals. I sometimes get asked about alternatives to venture style investing, because some people aren't big fans of venture capital. It is sexy, and a lot of us are drawn to that approach. But there are other approaches, and the other approaches can, I believe, more predictably deliver stock market equivalent returns. And if you can get yourself comfortable that you can earn stock market equivalent returns, then you can allocate more of your capital from your 401ks, your IRAs, and other investments into your crowdfunding investments with more impact. So there are a couple of portals like SMBX, Climatize, and Honeycomb Credit that are offering primarily debt deals. And those debt deals remove a lot of risk. These are still risky investments. I don't want to kid you. But if you're going to get, if you invest in a loan that's scheduled to be paid off entirely in 2, 3, 4, or 5 years, your risk is lower than if you are investing in a true startup. But if that interest rate is 8, 9, 10, 12, 14%, holy cow. Those returns on a portfolio basis could easily match what you could get in the stock market. So there are alternatives even to the idea of venture capital approaches, and you can explore all of those. Next month, I'll be excited to have a guest presenter. We'll be talking with Gene Massey. Gene will be here to present next month, and he'll be talking about some guidance for targeting the right investors and how to find them from a capital raising standpoint. It'll be a great session. I invite you to join us next month. Again, we'll be right here. You can find us wherever you're watching today. We'll essentially be in the same place next month. So I look forward to seeing you there. Thanks very much for being with us today, and we look forward to seeing you again.